Hello everyone, welcome to the fourth and final installment of OIC's June Summit. My name is Alexander Osinga, and I'm a staff member here at the OIC. I'll be guiding you through today's session. I'm excited to introduce our keynote speaker for OIC's Summit event, Sibo Vest's Joanne Hill. Dr. Hill serves as a Senior Advisor for Research and Strategy at Sibo Vest Financials and is a recognized leader in the financial industry, publishing a number of articles on options and indexing, and more recently has co-authored a comprehensive guide to exchange-traded funds, which can be found for download at CFA's Research Institute's website. Dr. Hill was a founding member of and co-president of Women in ETFs, where she currently serves on the board. We are thrilled to welcome Joanne Hill, who will present our final topic for today's summit, incorporating exchange-listed options into index and portfolio strategies. Joanne?
Thank you, Alex. And thanks to everyone out there in cyberspace. It is a great pleasure to spend time with you this afternoon talking about incorporating exchange-listed options into index and portfolio strategies. I of course, want to be sure that we make you aware of all the disclaimers that are key to utilizing these products in a proper way. And so we have the option industry, the OIC disclaimer here. Also a reminder that some of the securities listed here in registration, we're going to be mostly talking about index profiles, so but this is not an offer to buy or sell. Also, that the information here is in some ways some of these strategies are hypothetical returns based on back-tested index information. So always important to be aware of some of the constraints in interpreting and using some of this information in your investment strategies. So today I'm going to talk about the topics you see there on the screen in the agenda. I have worked for a few decades actually with large institutions, small institutions, financial advisors, as well as individual investors on index investing and option strategy design. I think that the time has come in today's market environment as we are more open to incorporating different return and risk profiles into our asset allocation buckets for option strategies to really see the light of day and for investors to understand the merits and features and where they fit. And so we're going to spend time talking about how options are really strategy transformation tools that can work within your portfolio and complement your other strategies. We're going to use some benchmark examples to look at return and risk features. I'm going to talk a little bit about a new approach to thinking about investing, target outcome investing, and how option strategies play a role in this type of approach to investing. And then we'll sum it up with comparing across different return and risk measures. We will, I hope, have some time for questions at the end, but so feel free to send those our way, and if we don't get to them all today on this webcast, we'll try to answer them, we'll follow up and answer at a later point. So let's start with looking at where we are. Where have we come since the 1950s in terms of the way we approach investment decision making? There was a lot of innovation between the 1950s and 1980s, but we haven't seen too much since then, I'm sad to say. We are still making investment choices within pretty much a two-dimensional system where we're defining return and risk based on normal or bell-shaped distributions. We often look at the world and evaluate investments in a single horizon, like 3 or 5 years. We might have observations within that horizon that we look at in daily, weekly, or monthly returns, but those aren't our horizons. Our horizons often are longer. We just use short-term data because that's the easiest to access. So we rely a lot still on manager skill and discretion, and we use standard deviation as our main risk measure. Now, where we should be, in my opinion, is that we should be using some new approaches to investment decision making that are more adapted to the reality of investing in the 21st century and some of the tools that we have, including exchange-listed options. We have multiple horizons, most investors, and we also have a more dynamic market environment where the investment arena is changing in risk at different points in time. It's also multidimensional. What I mean is that we have both top-down and bottom-up investing as important parts of the process. We can even, with ETFs and ETF options, trade to manage our sector exposures. Certainly technology is a sector in focus right now. And we don't really, investing is not a closed system. I know there's a lot of talk about zero-sum, alpha sum to zero, but that's only true if you have a closed system within a particular asset class. There really is much more of an open system where investors are jumping around and doing cross-asset class investing. So in this new world, we have market information that we can utilize. We can develop systematic strategies. We have a reality that return distributions are not symmetric. They are fat-tailed. I'll show some examples of this in a minute or two. Correlation changes, especially in falling markets. Correlation across equity indexes certainly rises. And we can observe the price of volatility. We can look at implied volatility and the extent of uncertainty that investors have as we look at options and derive measures from them. So we have investor preferences that are more focused on multiple horizons, and sometimes their horizons get shorter in more volatile markets. And we also know that risk preferences are not symmetric. People are willing to take upside risk but have more aversion to downside risk. This lends itself to what I'm going to be talking about next, is that with options and securities with embedded optionality, we have an ability to transform strategies to have different dimensions, different payoffs on the upside and the downside. So let's look at how this might work. So I like to think of options as having the opportunity or ability to reshape index and stock return patterns. And having said that, that sounds like a very powerful feature, but they've really been underutilized because they're very challenging to evaluate and to compare to conventional investments. Options pay off or provide profits when a price closes above a strike price for a call or below a strike price for a put. And so those payoffs are very asymmetric. They're zero or they're in profit, they have a profit. Also, they are focused on a particular point in time. They have an expiration date. And these features drive how options are priced and how they fit into portfolio strategies. And with this, it means that volatility, the range of returns, is a key driver. So another way to think of options is that they offer another means of managing equity risk and enhancing returns. And just like any other investment opportunity, they come with costs that must be weighed against the benefits. But sometimes these costs and benefits are different. They're not opportunity costs as you might have with a more conventional strategy. They might be upfront costs when you buy a call or a put option. Also, there's a feature of options that I'm going to talk about that there's more buyers of insurance than there are sellers of insurance. And so this provides an opportunity to take advantage of something called the volatility risk premium that is present in options. So let's just kind of flesh this out a little bit. So first of all, this is just a profile that shows how volatility conditions, when they're higher volatility environment, you will tend to have higher prices for options, whether it's a call or a put, because there's a greater likelihood that the option will be delivering a profit, be above or below a strike price. Also, you see here that the volatility dimension is time-specific. If you hear that the VIX is at 15, or 10, that's an annualized statistic. And so just like we talk about bond yields as the annualized yield, volatility is usually talked about the same way. But in fact, the volatility is different if you're talking about quarterly returns or annual returns. So just to give you an example, the volatility in a quarter is half of that for a year. It isn't linear. Let's look at a return distribution. This is the distribution of monthly returns for the S&P 500 going back to 1966, so about 50 years. And the red bars show what you would expect if returns were distributed normally, like a bell-shaped curve. The blue is what is actual. So what you see there is that, in fact, there is a higher likelihood of returns in the middle of that distribution, right? And also of extremely negative returns. So what we observe in the market is something slightly different than one might think of if you're using standard deviation or a normal distribution. This is also quite interesting. This is a profile of the historical frequency of returns, monthly returns, same as on the other page, but the black line shows the implied distribution from option prices on S&P 500 options. And you see that it's flatter and wider than what we actually observe in the marketplace. So this is part of the story of why there's a slightly, at least for index options, net benefit from selling rather than buying, because the implied distribution tends to be wider and flatter than the actual distribution of realized volatility or actual market volatility. Now, to look at this more specifically, I want to go through 2 pages here of charts of the volatility risk premium. So we can think of this as the compensation that investors want for bearing risk when markets move up or down. So probably the statistic you're most familiar with is the VIX. So the VIX comes from option prices, and it's the expected volatility 30 days out that's in S&P 500 options. And what we observe is that the actual volatility over the prior 20 days tends to be less than what is expected in the VIX. So if you see those orange bars there, that's the difference between the VIX and actual market volatility. So this is what we call the volatility risk premium. So this means there's a tendency for options to overprice volatility compared to what we observe in the market. We get often questions why this is true, and I think it reflects the fact that there are very short-term investors who are risk-averse and want to protect their positions from sudden and large moves. And also they are nervous of volatility expanding very sharply in a short period. And so these investors are willing to pay a bit more for options than what would be expected given the actual volatility in the market. Here's another blown up picture of this volatility risk profile. The typical spread between the VIX and actual volatility is about 4% in annualized terms. And this volatility risk premium is positive about 87% of the time. So it's important to appreciate this because what you're going to see as we use some examples of option strategies is that those that are involved with net selling of index options seem to have better return profiles according to conventional measures than those that would involve buying. Okay, so that concludes the section talking about options as strategy transformation tools. I'm now going to talk a bit about the return profile of option strategy benchmarks. So to do this, I'm going to utilize some research that was done by Wilshire, a paper in 2016, where they looked at the return and risk features of a few benchmarks that are listed here. Now, but before I get into this, though, I want to mention that I'm going to be talking about a few different strategies: buy writing, collars, put protection, and then target outcome. These strategies use S&P 500 options, or which some examples would be ETF options on SPY or on IVV that trade, of course, across many exchanges where you can find trading in these ETF options. But this can also be applied to a range of other underlying ETF options, such as those on Russell 2000, IWM, on EFA, EFA. So I think that what I'm going to illustrate here with S&P 500 can also be applied to other broad index exposures, also emerging markets options on EEM ETFs. So let's turn to the example indexes here. And so we have probably the one you might be most familiar with is BXM. So this is buying S&P 500 and selling calls each month at the money. There actually is an ETF on this, a benchmark to this index from PowerShares. PBP is the ticker. Another buy right index that is useful to see the benefits of covered call writing is to look at the BXMD. This sells options that are, it says 30 delta. What that means is they're out of the money. They have a 30% likelihood of exercise. So think of them as being about 2% out of the money in a typical month. So this allows for some room for upside, but capped upside. Another strategy, two strategies we'll look at that are more hedging or risk management strategies would be a zero-cost put spread collar index, CLLZ. So this would be this uses monthly options. In practice, investors use a range of monthly, quarterly, or annual, depending on their horizon. But this uses a monthly SPX put spread and sells an out-of-money call to cover the cost of that put spread. Another index, P-Put, illustrates a put protection index, 5% out of the money monthly. But you can see that as you do your own option strategies, you can choose the degree out of the money or the term. And finally, we'll look at a put writing index that invests in cash and sells put options to others, the right to sell to you the S&P 500 index. We're going to compare these to some common market indexes. I think you're familiar with most of these, representing U.S. stocks, EFA, bonds, and commodities. So let's take a look at, from this paper, at first the long-term return profile. This is a little hard to discern, but you can see that over a 30-year period, with the S&P 500 being the blue line, it does turn out that a couple of these option strategies, specifically the put right and the buy right index that sells out of the money options, do end up having a higher endpoint return. We'll look at annualized returns in a minute. Some of the other strategies have lower returns, but also, of course, they may have lower risk as well. This comes out a little bit better in this chart. So here what we do is, or Wilshire has done in their paper, is to sort these various option strategy indexes by the return on the left and by risk on the right. And so if you look at this, you see that the S&P 500 is the third highest in return, again over this 30-year period, that the benefit of selling options, capturing this volatility risk premium, which comes through in BXMD and put, actually has delivered slightly higher returns than S&P 500 with similar levels of risk. The other indexes also have lower returns but lower risk profiles. So on the right chart, you can see that, for example, the BXM, which sells at the money options, is going to have lower risk. It will have a beta significantly less than 1. It will be almost like putting up to 50% of your assets in fixed income or cash, and so you would expect it to have lower risk. And also, the put protection and the put spread collar strategies are reducing downside participation. And so they will be reducing the risk compared to S&P 500. The normal way we like to look at risk and return is, of course, on an efficient frontier chart. And so here we do that for these indexes that we're talking about here that incorporate covered writing, put writing, and some downside protection strategies. And in this illustration, you can see that almost all of these option strategy indexes that can be implemented also with ETF options come up in between bonds and stocks. And so the ones that are net short volatility, like BXMD, put, VXM, have a little bit higher return profile. But remember, the way we're looking at risk here is standard deviation, right? We don't have a risk measure that actually emphasizes downside risk. So it's no surprise that some of the downside protection strategies might look a little bit lower in terms of return relative to risk. Also, I think that this is important to see that you can't really compare these strategies to a fully invested S&P 500 or Wilshire 5000. When you're looking at option strategy indexes, you must look at return relative to unit of risk. I think that many investors today are looking at lower risk smart beta strategies, like low volatility strategies, like dividend tilted strategies that are available through exchange traded products. And so if you are willing to pursue lower risk profile strategies with stock selection, then this also opens the door to consider option strategies in the same context. For example, comparing an index like BXMD to potentially some of the low volatility indexes as an investment choice. Okay. Also included in the presentation deck is the year-by-year results for all of these different option strategy indexes and compared to the benchmark indexes. Now, if you look at this, of course you want to see how they did in years like 2008 when the S&P was down 37%. All of these example option strategy indexes have outperformed in that period. The one that did the best, not surprisingly, was the 5% put protection index, P-put, which was only down 20% in that period. In years of moderate returns like 2005, 2007, 2011, 2015, the Wilshire studies showed that these were also the types of years in which utilizing option strategies delivered better performance than S&P 500. And this is also even with the fact that they also did so at a lower risk profile. So I think this gives you, I think it highlights that by looking at some of the return features of options through option strategy indexes, you can get an idea of how they might fit in a portfolio. Okay, so I'm going to turn to the second part of the talk today, and this is to discuss target outcome investing. This is a topic that I have been working on in my at my role at Sibo Vest, but I think it is also being applied by many investment advisors who are focused on goal-enhanced investing and other asset managers who are looking to develop strategies that are geared to the investor's risk preferences. And this is a particular area of investing where option strategies are very key to coming up with the best solution. So I think that if we look at conventional investing, we find that, as talked about before, the approaches focus on annualized returns, standard deviation, but these are not necessarily what investors care about. They care about goals related to their capital stability, the growth of capital, if they're looking to provide for something very far down the road, or a young investor looking early in their investing life cycle, or they might be looking for income. And so with target outcome investing, the idea is to look at returns in the context of meeting financial needs, and also to find risk in terms of the returns that are needed to meet those needs. It's not a statistical measure of the variability of returns. It's more looking at the risk of loss to principal, at the downside features, and looking at it at a particular time frame when liquidity is required. So there's often in target outcome investing, there is a target time horizon, which is at the point at which you need liquidity. And I think it makes a lot of sense as to, I get a lot of questions from people, well, when the market starts falling and they're seeing on CNBC, this big loss in indexes, will I still be able to provide for my retirement? In fact, if you're retiring over the next 10 years and you're going to be taking out a small portion of money each year, those returns that are happening and scaring you on CNBC are actually not very relevant at all. So we can also think of this as, in terms of the different types of investors, as the fact that they might want to be targeting particular parts of the return distribution. So, for example, a capital stability investor might be willing to give up some upside gains in exchange for having less participation in losses in the blue area of the distribution. A growth investor might want to have greater participation or amplified returns in a moderate return market and be willing to give up those very high returns when the market is going up, soaring 20, 30%. Income investors also would be, really wanting a regular periodic income and would be willing to take some risk to get that income if the losses are limited, and they're limited potentially to returns outside of range. I'm going to give you some examples of these as we go through the remainder of the webinar today. So back to the picture of the return profile. I think this is a little bit different than I showed you before. This is a distribution of annual returns. So you can see the average return is 8%, but you also see the same thing we saw before, that the return distribution has a higher likelihood of extreme negative returns, a little bit higher likelihood of moderate returns, and less likelihood of the high returns. So the indexes that work on target outcome investing are focused on defined return risk profiles. So what they're going to look at is target return payoffs that might be defined in terms of a buffer. So might reduce downside for a range, or a cap, a point at which return you would be giving up returns, similar to what you might get in a covered call writing strategy where you're selling upside. Or you might look at a multiple of the underlying index return. These are the ways you describe the shift in the return distribution. The target can be in terms of reducing downside risk, enhancing returns, or looking for a more regular portion of return coming from cash distributions. Now, some of this terminology might be familiar to you if you've evaluated or invested in structured products. Structured products, of course, come from the balance sheets of banks or insurance companies, but with target outcome investing, you can get the same kind of return profile, but using exchange-traded options and having strategies that are more transparent, have an available history to analyze and observe. And this is really the new thing that is becoming available with option strategies. And so the options then are used as building blocks to deliver this target outcome. And when you're looking at target outcome investing, you can think of it to a specific term, or you can have a portfolio of positions that would roll over time. And I'll give you an example of that. So we're going to talk today about three different target outcome index strategies that have been created as CBOE benchmark strategy indexes. They can be applied, as I said, to exchange-traded options on SPY, on IVV, on a range of ETFs. The examples they use are based on S&P 500 index returns. And so we're going to look at some profiles of an enhanced growth, a buffer protect, and a range-bound index that is focused more on income distribution. Let's first look at the enhanced growth index. So this is designed for investors. This would fit more in an full equity bucket, and would be competitive with smart beta strategies. But as we know, many smart beta strategies like low vol or high dividend might be exposed to sector or factor underperformance. This strategy is invested in S&P 500, but it seeks to deliver outperformance in low and moderate return environments in which would amplify, and pays for that amplification by capping returns in other environments. So if we look at the chart on this slide, page 29, what we see is that the index would be looking at a portfolio of positions that are looking to deliver 2 times the upside up to a cap. The downside is just the same as the S&P 500. And so it's pretty clear that if this is the structure, then this would be amplifying or providing enhanced returns in more moderate return markets. Okay, so the index itself, the SPEN Growth Index, actually invests in a portfolio of these strategies that expire in 12 different calendar months. So as we said with target outcome, and options, you need to select an expiration. So these strategies are designed to deliver 2x the return to a particular calendar month. That's the building blocks. But this particular index rolls these 1/12 at a time every month. So you have this continuous opportunity to amplify these upside returns in a moderate range market. It may be clearer to look at a profile like this, where we're looking at what happens if the index is up or down up to 10%. And so you can see that in this enhanced growth index, you would be getting amplified returns if the index is up 10%. But most of the caps in these strategies that would deliver this 2x upside cap returns in the 16 to 18% range. So if you were observing a market of 20% returns, you might not be participating above that level. So if we look at what are the key return and profile features here of these strategies, you see that, as I said, amplified returns up to a cap. The volatility expectations are priced in the options, and it does benefit. The cap gets higher in higher volatility regimes. And it does capitalize, you're getting the alpha or enhancement from that volatility risk premium that I talked about earlier. So here's some return results from this index that you can find on the Sibo benchmark strategy website. And what you see here is some of the things I've been talking about, so that the upside is greater than the downside, upside participation of 125%. The return differences from annualized S&P returns are in the neighborhood of about 1% a year for 10-year time period. But what is interesting is that the periods of outperformance are really highest in those moderate return markets. So this chart is a chart of return deciles of the S&P 500 and a table. And you can see on the left that for deciles 3 to 8, when the S&P has returned between 3 and 20% return, this is the type of environment where this type of strategy would deliver its most outperformance. Great. So that's the first example I gave you, which was the Enhanced Growth Target Outcome Index. The next example is a Buffer Protect Index, which would be used more for downside risk management or capital stability. So this strategy and index is looking to protect against the first 10% of losses from a decline in the S&P 500. And it pays for that range protection by capping upside participation up to a cap level. In these indexes, the cap is determined annually, so the term or horizon is 1 year. So I can show you a little bit better what the return profile looks like by a chart like this, where we look at what would be the return if the index is up or down 10%, or up or down 20%. So what you see here, since this is a buffer protect for a 0 to 10% range, it would have, if the index was down 10%, you would have the full protection come into play. If it was down 20%, because it's a spread or range, you would still participate in some downside, but you would tend to outperform by about 10%. So less downside participation. On the other hand, if the index is up strongly, you would potentially have underperformance. I think that investors that look at this type of a strategy understand it better if they're looking at this type of chart. So this shows the cap. This shows where you're capping returns historically to pay for this downside buffer protection hedge. And what you see here is that the cap gets higher in the volatile years of 2007 to 2010. The cap that you would need to get buffer protection is very high, so you have more upside. More recently, the cap has been more like 9 to 11%. 13% was the highest in the last 12 months. But nevertheless, the opportunity cost of returns above this cap would be what would be financing the outperformance on the downside. The results in terms of returns based on the history of this index are shown here. So first, I think the best way to describe it is showing that the upside capture, the portion of S&P returns on the upside is 85%, but on the downside only 55%, 56%. So it's reshaping the return distribution to reduce downside participation. Again, it's lower risk than S&P 500, so you're not getting 100%. It won't beat the S&P 500 over the long market cycle, but it does give you less downside participation. And this type of strategy would fit in a portfolio in the similar way that you might use any other lower volatility type strategy. You can see in the chart on the right the fact that the risk, the standard deviation of returns, which is the conventional way of looking at risk, is lower than that of the S&P 500. The final strategy I'll be looking at is going to be something that is focused on income. I know prior sessions today in this OIC webinar series have looked at income strategies. And it shouldn't surprise you that that volatility risk premium that we went over earlier is if we can capture some of that risk premium by selling options, there may be a way to provide a more consistent cash distribution. So that's what this type of strategy is designed to do. So there's a third index that is called the Sibo S&P 500 Range-Bound Premium Income Index. And so this is an example of a strategy that is targeting consistent periodic distributions. More specifically, it's looking to generate 0.6% of premium income every month, which translates to about 7% of income a year. And so the target return, and the funds are invested in cash, so you're getting, in effect, a cash equivalent return with very limited credit risk in a strategy like this, because you're basically investing in short-term treasuries. And then in addition, you're getting the premium income from selling calls and puts for an out-of-the-money range. This is the way the strategy looks in terms of the charts we've been showing. So there's a range in which the fund would seek to suffer no loss, or the index. If you go outside of that range, you would be open to experiencing losses because you would be selling options and be exposed to the performance of S&P outside that range. So let's go back to looking at the S&P return distribution and see where this what likelihood might be of earning that income that we're targeting versus experiencing losses outside the range, because this is kind of the way to think about the cost and benefit of an income-based strategy with options. So we're going to use an example, as this index does, of selling every month puts and calls outside of a range. And so here is a distribution of returns and of S&P monthly returns. And at least going back over this period of 50 years, 97% of the returns have been within plus or minus 10%. Remember, we're talking about monthly returns. About 82% of the returns have been within a range of plus or minus 5%. So this gives us a natural place on which to sell options. Between 5 and 10% out of the money should be a pretty range in which in most months we're able to capture that income. In fact, if you look at this index, you will see that it's designed with this target of 60 basis points per month to look at the options that it would sell. This chart, the green bar, shows the percent out of the money that the calls are sold, and the red bar, the percent out of the money that the puts are sold to generate the target income. There is a maximum of 3% a month that would be the limit of the target, and so there are some months in there in 2008 and 2009 when volatility was very, very high that you could realize even more than 3% a month. So there is a cap on the amount of income. But you can see here that the blue bar, the blue line, which is the S&P 500, has broadly stayed within the range that would generate the 60 basis points of income per month. More recently, because as we know, volatility has been very low this year in 2017, so to generate that target income, the cap has come in closer, more around the 5% level on the calls. I'm going to give you some examples of the return here. That we get a question when you talk about this index. You say, well, what would have happened in 2008? How much would I have lost? And so, in fact, it's a very interesting year to look at. Here in October 2008, when Lehman Brothers collapsed, the S&P was down 16%. So it would have gone out of that 10% range. But in fact, the volatility that's priced into options was so high at that time that the range had naturally widened. So there was a bit of a loss in that month, minus 0.88% with a strategy like this. But what happens is when you have an event like that, in the subsequent months, the volatility goes up. So you're able to capture a higher level of premium with a strategy like this, with a range-bound premium income index. So even though there might be a month or two of losses, the event would provide higher income in the following months. So over longer periods, the returns come back. So we see this if we look at the calendar year returns for a strategy like this. I think that the period from 2012 to 2016, returns in the 7 to 10% range with this target income is more what you would expect going forward. We all hope that those years of high volatility that we had during the financial crisis will not be repeated. But in fact, this type of strategy where you're selling that high volatility with a target income would have performed well because there was so much reward from selling volatility during that time frame. Another way to look at the risk of this type of strategy is to look at the frequency distribution of the one-year returns, and you can see what the likelihood is of negative returns. So pretty small likelihood. About 82% of the returns are within 0 to 20% of the returns on a one-year period. Okay, so finally we are at the end of the talk here, and I'm going to conclude with some comparison of some of these strategy and option strategy and target outcome index based on S&P 500 ETFs or S&P 500 options. And what I'm showing here in this chart, and we'll look at an efficient frontier, is we're just looking at these strategies come with different correlations to the S&P 500, as you can see on the left. They have different betas in most cases, except for the enhanced growth target outcome strategies. They have betas or market risk less than 1, so they're lower risk than S&P 500. And you can see by looking at the calendar year returns that in many cases they have smoother rides, right? They have less negative returns than you would experience in an S&P 500 strategy. It's always easier to see what's going on by looking at a return risk chart. This is annualized returns and volatility for the 10 years ending 2016, as we looked at before. You can see here that compared to S&P 500, right, as we said, the selling of options or buying protection strategies reduces risk, with the only exception being the span enhanced growth strategy, where you're looking to amplify moderate returns. But one of the things I emphasized was that looking at return and standard deviation was not sufficient, that it's important to look at upside and downside participation, because investors really care not just about volatility, but about downside volatility. So in this final chart, I've shown you these strategies with, on the y-axis, the upside capture, and on the x-axis, downside risk or downside volatility. And here you can see how much the protection strategies like P-put and the CLLZ, the collar strategy, do take the risk down significantly compared to S&P 500. SPRO, which was that buffer protect strategy, also provides significant risk reduction. A little bit of a give up in return, but as we showed you, less downside participation. And a strategy like SPEN that has higher upside capture relative to risk moves out relative to S&P 500. So to conclude, we've covered a huge amount of material. I know this is complicated, and I've gone through these slides very quickly, but I know you have them also available to you to view at your leisure. So I'll summarize by saying that options expand the choice set, and we've illustrated this with option strategy indexes. Investment horizons are different today. They're not 3 years or 5 years. They're based on financial needs, wealth accumulation goals. Investors care about downside risk. They want to understand not just return and standard deviation, but the profile of the return distribution. Also, we have available to us exchange-traded options on a range of ETFs, and we can design rules-based investment processes. Just like we're doing with smart beta, it can be done with option strategies as well. And so this allows us to rely less on diversification. We also have, in utilizing options, the fact that the price of volatility in options tends to be higher than, especially index options, than realized volatility. So this provides for an opportunity to provide some enhancement in option strategy design. And so if you have a specific investor horizon or target return profile, then option strategy indexes and option strategy design can be very useful to you. So at the end of this presentation, I just summarized the indexes that we talked about today. And so I'm going to stop there and see if Alex has collected any questions from the audience.
Hi, Joanne. Yes, we did get a couple questions. One, someone wanted to know, where can I learn more about these strategies? Okay. Well, I guess there's a couple different ways you can do this. Let's see. So I referred to so the with full disclosure, one of my nonprofit activities is I'm on the board of the CFA. I think you're familiar with CFA. Most people on the call, Chartered Financial Analyst Program. The CFA Research Foundation puts out education guides for the investing public. And so the CFA Research Foundation, if you Google that, you'll find their website. They have a very good monograph on option strategies, a tutorial written by Roger Clark, and I'm going to forget the other author. But that would be just the same way I've participated in a book on ETFs for them.
there's a monograph there on some option strategy design. In addition, the CBOE and the other exchanges on their websites, the other exchanges that offer options, often have very, very good education tools. All of these benchmarks that I mentioned are on the Sibo website with supplementary material describing them, and there's some Wilshire consultants and other consultants have written papers outlining this. Let me think of some other references, but the options industry, the people, of course, sponsoring this, the Options Industry Council sponsoring this webinar, put on programs throughout the course of the year that talk about some of these concepts as well. Alex, you may want to add something there.
Yeah, I'll go a little bit into greater detail when we wrap up, but I want to get to these questions before we close out our summit event today. I'll ask this question. Let me know if you're able to address this. How could an investor buy into the BXM, BXMD, etc. through ETFs?
So, well, right now there is not an ETF on BXMD, so you would have to do this more on your own, buying SPY or IVV and then selling SPY options that have a delta of 30. But the BXM, as I mentioned, that is available in an ETF from PowerShares. I think it was, I had the ticker here, I'm looking it up, PDP, I think. And the put right index is Wisdom Tree, PBP, Paul, Bob, Paul, is a ticker for an ETF on BXM. And PUTW, PUTW, there's an ETF from Wisdom Tree that's available on the put right index. So those are the only two ETFs that are out there right now that I am aware of. Sibo Vest has mutual funds on the target outcome indexes, and so you could find them by going to the Sibo Vest website. But currently those are available in mutual fund form.
Okay. And then are there any ETFs which use this strategy? I'm not sure which strategy they're referring to, but...
So, right now, I think that there are, stay tuned for another year, because I know that there are ETFs in the works from some asset managers on these indexes. But right now, as I mentioned, there's mutual funds on the target outcome indexes from Sibo Vest and just these two ETFs. That's it for now.
Okay.
But also your financial advisors, many of them do have the ability on their teams to do option writing strategies against using ETF options. And so there may be, some of you may find if you ask your financial advisors that they can do something very close to these indexes for you on a discretionary basis.
Okay. I have another question from one of our viewers. Are there any ways to use VIX and or options to predict directionality and movement, particularly for the recent volatility in the tech sector? Is that something that you can touch base on?
Yeah. I can touch base on it, but yeah, the VIX is not, I've really actually looked at this in my former role as a derivative strategist, and unfortunately the VIX is not a very good predictor of direction. It tends to be looking backward more. It tends to be more reactive to the range of returns that has recently occurred in the marketplace. So, I think that it is interesting to see this year we have had, a few more episodes of volatility. I just did a little blog on, how long can the VIX stay low, and it's often the case that we have episodes like these little, we've seen in the last month or two more moves of greater than 1% a day. So those are signs of sort of like heat lightning, that something's coming. But it doesn't predict direction. It just says we might be changing the volatility regime we're in when we get more of these days where we get bigger moves, especially to the downside.
Interesting. Well, thank you very much, Joanne. This was a really fascinating presentation, and we appreciate you sharing your insights as well as your time with us. So thank you very much. Ladies and gentlemen.
Well, thanks. It's been enjoyable to do it.
I'm glad to hear. Ladies and gentlemen, thank you as well for your time today. If we weren't able to get you to all of your questions, we have our investor services desk ready to help. Feel free to reach out to them at options@theocc.com. That's options with an S @theocc.com. And many of you asked about further education. Please visit optionseducation.org, the OIC's website, and see the Getting Started section for further reading. You can learn more about the strategies as well as other information about options education. And of course, make sure to check out the website for upcoming webinars and other events. And with that, thank you for attending, and we hope to see you again next time. Thank you.